Hello, my name is Perry Tepperson. I'm a CFA charter holder and also an actuary by profession. I work in the investment consulting business. I want to practice advising a wide range of clients on investment strategy issues. Today we're going to talk about portfolio management and capital market theory. The first topic we're going to cover is we're going to talk about rates of return. How are those rates of return broken down, and what are the components that make up a required rate of return? And I'm going to use my slide to illustrate this. A required return is made up of three components. Firstly, the risk-free rate. I use abbreviations very often in my work, and you can feel free to use them as well in your preparations for the exam. The risk-free rate is the rate that investors require, ignoring any risk considerations. Essentially, the rate that somebody requires when they lend money to somebody else. They also require to be compensated for expected inflation. And because there's often some risk involved, there's a risk premium as well. And those three components you need to add up, all three together, to get a required rate of return. The risk premium is broken up into various subcomponents. And I'm going to get to that a little bit later on. Stepping into the notion of the real risk-free rate of return, which is the first component, ignoring any inflationary considerations. That is affected really by the supply and demand for money. People who have capital and are willing to lend it to others who need it expect to be compensated, and the extent to which they can demand compensation is affected critically by how many lenders there are out there, in other words, the supply, and how many people there are on the other side of the table who want that money. That's going to affect the rate at which transactions occur until there's some equilibrium between those who provide capital, those who want capital, leading to a risk-free rate of return. It's affected by a couple of factors. One is time preference. People generally want to consume today, don't want to consume later on. So if I'm going to lend you money, you better compensate me by paying me a return because I have foregone current consumption for future consumption. And it's also affected by opportunities out there in the marketplace. When there's a lot of investment opportunities out there, there's a lot of people competing for capital. And that really relates back to the supply and demand phenomenon. Now, the next topic calls for us to spend a bit of time thinking about the nominal risk-free rate of return and the real risk-free rate of return, and also compute both of those. Now, why is that relevant? If you step back and think for a moment about the needs of an investor that has a very long-term time horizon, they're going to be interested not just in a risk-free rate of return as a starting point for their compensation, from a nominal perspective. They're also going to be interested in what are they getting in an after-inflation context, because their obligations and their commitments are always increasing with inflation. So they're going to be looking at two items. One is the risk-free return from a real return standpoint, and one is a risk-free return from a nominal standpoint. And how do those two blend together? Let's have a look at the equation. The nominal risk-free rate of return, no surprises here hopefully, is really a combination of the real risk-free rate and the expectation of inflation. But the relationship is a geometric one, not an arithmetic one. You've got to multiply the required real risk-free rate by the inflation level to get the nominal risk-free rate. And I have an example here. If the inflation that's expected is running at about 2.5%, and the required real risk-free rate of return is running at about 3%, you've got to multiply these two out, not forgetting that these are percentage items. So a 2.5% number is really 1.025. 3% real risk-free rate is 1.03. And when you multiply these out together, you get 1.056. 1.056 translates into a 5.6% nominal risk-free rate. Just by way of interest, where did these two numbers come from? Well, they're hypothetical. In the examination, you would probably be given these two items. But for your interest, the market signals that I would look to draw from these two would be the current real rates that are in the marketplace and being offered on government bonds that provide inflation protection, TIPS or real return bonds. And that would be an indicator of the current real risk-free rate of return. And the current level of inflation is something you can look up as well in the financial press. But in the examination, you're likely to be given these two numbers, almost certainly, and you might be asked to compute the implied nominal risk-free rate of return. You could, of course, derive any one of these three given the other two. So bearing in mind, you may want to rearrange this equation and work out the real risk-free rate of return given the nominal and given the inflation level, or work out the implied inflation given the nominal and the real, just using simple algebraic principles. Now, the next topic we're going to cover here is this risk premium we've been talking about. What is the risk premium all about, and how does it break down? Now, the risk premium is really, as we've discussed earlier, compensation. If I'm going to lend somebody money, if I'm going to transact with them, give them money, and expect to be paid a return over a period of time, I'm going to want to get paid for the risk I'm taking. Obviously, one of the most basic risks you can think about from a common sense standpoint is the person I'm lending money to might not return the money back. I mean, there's a risk of default. So I think the notion of there being a risk makes a lot of sense, given that somebody is giving money to somebody else and isn't going to be repaid for a period of time. Let's look at the various components on the slide here. Again, it's compensation for being willing to risk your capital, give it to somebody else, and run the risk of perhaps not being paid back. But really, if you break down the risks, there are 5 of them. The first risk is the business risk. Now, the business risk, I think, probably makes the most sense from a stock perspective. So if you buy the stock in a company, and Coca-Cola might be an example we can think about for a second. Coca-Cola, as you well know, is a global brand, company that's headquartered in Atlanta, so it's a stock that's traded on the U.S. exchanges. But its business is spread out around the world. Now, a couple of years ago, Coke had a problem. The problem that Coke had was in Europe. And there was an issue regarding contamination of some of the Coke beverage in the bottling plants. So what happened was a whole lot of Coke had to be pulled off the shelves, off the stores, and that led to a temporary slowdown in their business in that part of the world. More importantly, it led to some concerns, some issues around Coca-Cola, presumably for a short period of time. Even though consumers of Coke are very loyal and love their brand, if there's any kind of a scandal or a question mark, it could impact on the stock. So that's a business risk. It's a risk that you face when you buy a Coca-Cola stock, that something might happen to the product, to the distribution, which could impact the performance of the stock in that period of time. And given that your intent may only have been to hold the stock for perhaps a 1-year period or a 2-year period, you may end up seeing a decline in the price of that stock, potentially, in an environment like that. The second risk is financial. And again, a company like Coca-Cola would typically, not looking at Coca-Cola's financials necessarily, but just thinking about it hypothetically, would access capital in a number of ways. They would borrow from people who are willing to buy its bonds, so that's debt. I just use D for that. And they also access the markets through equity, so they can issue more stock. Now, when you access the debt markets, you ultimately hope to earn a higher rate of return on your capital than the rate that you're paying to the bondholders. And this is really financial leverage. You don't need to get into that level of detail for this particular topic in level 1. But suffice it to say that whenever there's leverage on a balance sheet, and whenever a company has borrowed money by issuing bonds and invested that in the case of Coke, perhaps opening up a new plant or expanding into a new area of the world, they've increased risk because they've got to earn a return on their capital which exceeds the rate of return that they promised their bondholders. If they fail to do that, they run into financial trouble. That's another risk, that the debt-equity balance could reveal some nasty surprises if the rate they earn doesn't exceed the rate that they're owing their bondholders. The next risk would be liquidity. Again, I'm using abbreviations. I find when you're studying, there's not enough time to write out everything in full and cover the material quickly. So feel free to use these if they make sense to you. Liquidity would be the risk that the accessibility of the money that you've lent isn't easily available.